All right, let's cut through all the noise. Instead of chasing the daily headlines and all the chatter, we're going to do a real deep dive today. We're looking at a single, real-world investment in Alphabet to really understand the conviction behind holding on for the long term. So, let's just jump right in.
Everything we're about to discuss, everything we're going to unpack, is anchored by this one number, $193.95. Now, this is not some random price I pulled out of thin air. It's a really powerful entry point that, honestly, sets the stage for this entire case study. And here are the specifics of the position itself. We're talking about just over 100 shares of Alphabet, scooped up at that average price. And as you can see, the position is already up over 40%. The reason I'm showing you this is because this isn't just theory. This is a real stake, which makes understanding the why behind it, well, it makes it all the more important.
Okay, so how do we know if that was a smart move? How do we test that entry price? Well, first up, we're going to turn to an absolute legend in the investing world, Peter Lynch. His whole philosophy, his entire game was about finding these fantastic, fast-growing companies, but, and this is the important part, not overpaying for them. His secret weapon, his go-to tool, was something called the PEG ratio, and it's actually a pretty brilliant and simple idea. It asks one crucial question. Is the price you're paying for a stock actually justified by how fast its profits are growing? It pits the company's price-to-earnings ratio, which is basically how expensive the stock is, directly against its earnings growth rate. For Lynch, the magic number was 1.0 or lower. If you found a stock with a PEG ratio under 1, it was like a big flashing sign telling you that you were getting all that incredible growth at a bargain price.
So let's actually run the numbers for Alphabet. You take its PE ratio, which is around 25, and you divide it by its earnings growth rate of 30%. The math is pretty straightforward, and what you get is a PEG ratio of 0.84. Now, according to Lynch's golden rule, that's not just a pass, that is a strong buy signal. It suggests that the market, for whatever reason, is underestimating just how fast this massive company can still grow.
Lynch also absolutely loved to find a disconnect between how a company's business was doing and how its stock was behaving. And this is exactly the kind of thing he looked for. You can have a day where the stock drops 3%, probably driven by some market noise or fears, while at the same time the actual business itself is projecting earnings per share growth of over 34%. When the stock price zigs down while the business fundamentals are zagging up, that's what Lynch called a prime buying opportunity.
So let's put it all together. What's the verdict? Well, Peter Lynch would probably look at Alphabet and call it a stalwart, a big, stable company that's still growing like a much smaller, faster one. You've got an excellent valuation with that PEG under 1, a balance sheet that's an absolute fortress, and growth that's just superior for a company of its size. That entry price of $193.95, yeah, that looks like a textbook Peter Lynch investment.
So the Lynch test gives us a really strong thumbs up on the valuation. But hey, it's always good to get a second opinion, right? So let's add another layer of analysis from a totally different perspective. We're going to bring in the experts at Morningstar. They use this really rigorous, data-driven approach to figure out what a company is truly worth, once you peel away all that daily market chaos.
Okay, take a look at this. On the far left, that bar is our entry price, that 193 we started with. In the middle, that's roughly where the stock is trading today. But the number that really grabs your attention is on the right. Morningstar's fair value estimate of $340 a share. This chart doesn't just show the profit we've already made. It visually highlights the huge potential upside that these professional analysts still see in the business.
And to put a really fine point on it, just think about this. Even after a 40% run-up from our entry price, Morningstar's deep dive analysis concludes the stock is still trading at a 20% discount today. That suggests there's a pretty significant runway left for this thing to grow.
But look, it's not all sunshine and roses. It never is, right? Every great investment story has a central conflict. And for Alphabet, it's this constant tug of war between the super optimistic, bullish vision for the future and the very real, bearish risks that could derail the whole thing. Let's break down that debate.
So on one side, you have the bulls. They see a future where Alphabet absolutely dominates in AI monetization, where their cloud business becomes a massive profit engine, and where YouTube just continues its unstoppable growth. But on the other side of the coin, you've got the bears, and they point to some very real risks. These skyrocketing expenses to build out AI infrastructure, the constant threat of antitrust lawsuits from governments, and even the scary possibility that new AI tools could actually eat away at their core search business. This is the tension that every single investor has to weigh.
So with all those risks hanging out there, why hold? Why not just take the profit and run? Well, the final verdict,
The reason for conviction, it all comes down to one of the most powerful concepts in all of investing, the company's economic moat, its deep, sustainable competitive advantage.
And let me tell you, Alphabet's moat is incredibly wide. First, they have this full-stack AI advantage. They own the whole pipeline, from the custom chips to the AI models like Gemini, all the way to the Android operating system on billions of phones. Second, Google Cloud is no longer just some project that costs money. It's becoming a profit-gushing engine. And third, they have a literal mountain of cash that they use to buy back their own stock, which automatically makes every share that's left just a little bit more valuable.
And all of this brings us right back to the central question, the one every long-term investor has to face in the mirror. When you see your screen turn red, like that 3% dip we saw earlier, what is it that gives you the conviction to not just hold on, but to actually remain confident?
And here it is. This is the crucial takeaway. For a company like Alphabet, a true stalwart, a giant with a wide and durable moat, the simple passage of time is a far more powerful ally than trying to perfectly time the market's short-term mood swings. The real lasting value is in the business itself, not in the little blip you see on the screen on any given day.